Welcome back to the Deep Dive. You've given us a really complex stack of sources today, all focused on high finance and, well, some very specific real estate.
We are definitely going deep into the boardroom on this one.
We are. We're looking at Hanison Construction Holdings and their decision to sell off some pretty substantial assets in Hong Kong.
Specifically, their service departments.
Exactly. And this isn't just about selling a few buildings. This is, from everything we're reading, a really strategic move. It's a signal about their corporate direction. It's about shoring up their finances.
Enhancing liquidity, as they say.
Right, and reallocating their capital. We're basically analyzing their corporate playbook, what they're selling, what they're keeping, and most importantly, why.
And this is so important to watch because Hanison is controlled by the Cha family, a very powerful player.
So their moves aren't just about one company.
Not at all. They're often seen as a bellwether for the whole regional property market, especially right now. It's a masterclass in how a huge portfolio is managed when there are, some serious economic headwinds.
So our mission is clear. We need to unpack these sales. We need to understand their value-add investment strategy, which is pretty aggressive.
Very aggressive.
And then there's the paradox we need to solve. Why are other investors apparently so eager to buy these rental assets right when Hanison is selling them off?
It's a fascinating puzzle. You have a company trying to stabilize its finances,
while at the same time running this high-risk, high-reward flipping strategy. Balancing those two things is where all the complexity is. Okay, so let's start with the flagship sale that's happening right now, the one all the sources are pointing to, the Mercer.
Right, the Mercer. This is a 55-unit service department building.
And the location is key here.
Absolutely.
Yeah.
It's in Sheungwan, Hong Kong. That's a prime location for business travelers and professionals who need an extended stay solution.
We're talking studios, one-bedrooms.
Exactly the kind of inventory that an organization like MoveAndStay.com specializes in. They connect corporate teams, entrepreneurs with these sorts of places for stays that are longer than, just a few days. That built-in demand is crucial.
Okay, so JLL is marketing it, and they're running what's called an expression of interest process.
Yeah.
For anyone listening who isn't deep in commercial real estate, what does that actually mean?
It's a good question. An EOI, or expression of interest, is basically a way to test the market. They're inviting non-binding offers to see who's serious before they commit to a formal sale.
It keeps their options open.
Exactly. Creates a bit of competition. And this isn't some rundown building either. It has a hotel license, and it was actually renovated just a few years ago, back in 2021.
So it's a ready-to-go asset. Which brings us to the financial twist, the part that's so revealing, the estimated value.
It's between HK $380 million and HK $500 million.
And the key detail from our sources is that this valuation is a significant markdown from what Hanison originally paid for it.
A huge markdown.
Wait, hold on. If your goal is to raise cash, why would you accept a loss on a prime asset? Especially in a sector that seems pretty resilient. That doesn't add up.
Precisely. And that markdown is the first big piece of the puzzle. It tells you how urgently they need to free up capital.
So it's a cost they're willing to eat to get the deal done fast.
Yes, but to make that deal even sweeter for a buyer, they're offering two massive incentives.
Okay.
First, it's being offered with vacant possession.
Which in Hong Kong is gold. Right?
It's everything. It means the new owner gets a completely clean slate, no messy tenant issues, no long-term leases to deal with. And second, they're selling it without any brand or management strings attached.
So a new owner could come in and immediately pivot. They could turn it from a service department into a co-living space, or maybe use that hotel license for student housing, and there's no red tape.
Maximum flexibility. It's a clean break for Hanison, even if the price is a little lower than they might have hoped for.
That's the trade-off then. Take a haircut on the price to guarantee a quick, clean sale so that capital hits the balance sheet.
That's the strategic compromise.
Which brings us right to the core question. Why? Why this urgency? Why sell, especially an asset class that seems to be doing okay?
Well, the need to boost their liquidity is front and center. The sources are clear. Hanison has reported 2 straight years of losses.
And it's not just one thing that caused it.
No, it's a trifecta of pressures, really, all coming from the wider economy.
Can you break those down for us in simple terms?
Of course. First, you have fair value markdowns on their investment properties. So think of this as the paper value of their existing assets just dropping. They haven't sold them, but they have to officially state they're worth less.
Okay, a paper loss.
Right. The second one is write-downs of properties under development. This one hurts more. It means the money they've already spent building or renovating something is now more than what the finished property is expected to be worth.
So they're acknowledging a loss before it's even finished.
Exactly.
Yeah.
And the third pressure is one everyone's feeling: increased interest costs. Borrowing money is just more expensive, and that eats directly into your profits. Selling assets is a direct, almost defensive reaction to those three headwinds.
So these sales, even at a markdown like the Mercer, are about raising cash to fight those losses. But they're using a very specific playbook to do it, this value-add investment strategy.
That's their whole game. In essence, they're very sophisticated property flippers. They specialize in redeveloping and repositioning what are called en-bloc properties.
En bloc.
It just means they buy the entire building all at once, not just individual apartments. They buy it, they pour money into improving it. That's the value add. And then they try to sell the whole thing for a big profit.
It's a high-risk game.
Very. The timing has to be perfect.
And to see just how well this strategy can work, we have the perfect example that happened right before the Mercer. I'm talking about the sale of 111.
111, yes. This one was in Sayangpen, a smaller building, only 26 units, but the numbers here are just incredible. Hanison sold it for HPay $420 million.
And here's the kicker. They had only owned that property for less than 4 years. And in that time, they managed to get a 66% markup.
66%. It's a staggering return.
It's the perfect illustration of their playbook in action. That's what the value-add strategy is supposed to do. It's the proof of concept that justifies the whole business model.
And it creates this amazing contrast for you, the listener. You have the massive success of the 111 flip on one hand.
A huge injection of cash, massive profit.
And on the other hand, you have the Mercer, which is being sold at a markdown. The successful flips are essentially funding the necessary, less successful exits.
It's the reality of managing a complex portfolio when interest rates are climbing. Not every project is going to be a home run.
And we also have to remember this isn't just about these two buildings. The sources confirm this realignment is happening across their entire portfolio.
Right. They've been selling off units in industrial buildings, logistics assets.
But the other huge signal was that commercial building they sold earlier in the year.
The one they sold with Angelo Gordon & Co. for HK $1.1 billion.
Exactly. And that partnership is really telling. You partner with a huge institutional investor like that when you're selling a massive, complex asset that requires really deep pockets. It wasn't a quick flip. It was a major strategic exit to get maximum liquidity.
So they're moving fast, and they're moving decisively on all fronts.
Which brings us back to the big picture. What does all of this activity actually tell us about the Hong Kong commercial property market as a whole?
Because the immediate thought is, if a huge player like Hanison is seeing losses and selling at markdowns, the market must be in trouble. So why are they even finding buyers?
And that's the key nuance. While the overall commercial market, traditional office towers, big retail spaces, has definitely seen a decline, the specific rental residential sector is proving to be incredibly resilient.
It's a favorite asset class.
It absolutely is, because it's tied to that fundamental need for housing, co-living, extended stays. The demand side is always there.
It doesn't fluctuate as wildly as office occupancy rates.
Precisely. And we've seen other recent deals that prove investors are still very interested in this space.
For example?
Well, there was that hotel that was bought specifically to be converted into student housing, a total pivot. And then you had PGM Real Estate and Dash Living buying another hotel to turn it into a co-living space. These are big players making big bets on the long-stay housing segment.
So for you, the listener, what this means is that Hanison is selling into the one part of the market that's actually strong. They're using that rental residential resilience to either cash in on huge gains, like with 111,
or to cut their losses and free up capital, as with the Mercer. It's a masterclass in adjusting your strategy under pressure. They accept a markdown because it achieves the main goal: get cash, stabilize the balance sheet, and get ready to redeploy that capital into new opportunities.
This has been a really critical look at a very specific corporate playbook. The core lesson here seems to be that for this value-add model to work, strategic selling is just as important as strategic buying.
It's a constant balancing act. You have to balance the profitable flips with the necessary portfolio adjustments just to keep the whole machine running.
Especially in a market that's fluctuating so much.
And that leaves an important question for you to think about. We know the rental residential market is resilient. We see it in those hotel conversions. But why the big markdown on the Mercer specifically? Is it just a reflection of how much capital a new owner needs to spend to modernize it?
Or is it something else?
Or is it maybe a sign that the segment strength is very localized, that maybe Sheungwan is becoming a less desirable district compared to other areas right now?
That distinction is exactly the kind of critical thinking you need to apply to these deals.
And one final thought for you to mull over. This trend we're seeing, hotels and service apartments being sold for these non-traditional uses like student housing and co-living it, highlights just how fluid property types have become.
The old definitions are breaking down.
They are. So the question is, how quickly can market pressure force a property owner to completely pivot an asset's function? We are moving so fast beyond the traditional service department. The future is in these specialized, niche, long-stay housing options. And that ability to pivot, that's what's going to separate survival from obsolescence in this market.
A fantastic analysis. Thanks for walking us through Hanison's playbook. And thank you for sharing your sources with us for this deep dive. We will see you on the next one.